Hi, thanks so much for joining in. You're watching BQ Prime. My name is Alex Mathew, and this is an earnings conversation with the management of Mahindra Holidays and Resorts. Let me introduce you to Kavinder Singh, who is the Managing Director and Chief Executive Officer of the company. Thank you so much, Kavinder, for taking the time and for speaking to us. As I look at the numbers for the fourth quarter and indeed for the full financial year, but specifically for the fourth quarter, I see strong performance across various metrics, whether that is, in fact, the member additions or, in fact, even membership sales, occupancy, upgrades. But I want to hear from you, what, according to you, stood out in the fourth quarter?
So I think, typically fourth quarter is not a very high occupancy quarter. It turned out to be a great quarter in terms of occupancy, is 85%. We saw the highest ever upgrades in our history in this quarter where members want to upgrade their membership. And the other thing which stood out to my mind was the fact that we were able to add significant inventory in this quarter. We added about 256 rooms. We reached almost close to 5,000 mark, whether it is domestic destinations, which are, Himachal or in Sikkim area, as well as in Andhra Pradesh area and Gujarat. But parallelly, we added inventory in Maldives, Vietnam, Cambodia, Abu Dhabi, and Nepal. So it was, and we crossed the 100 resort mark in this quarter. And most importantly, if you look at our resort income, in this quarter was the highest ever at 80 crores. And if you were to look at full year also, we have hit a big benchmark of crossing 300 crores and we stand at 323 crores. So if you look at the growths, whether it is memberships, whether it is upgrades, whether it is the income, whether it is the EBITDA, whether it is the PBT, all the growths are in very high double digits. And, at the PAT console level, of course, it has been, 4x roughly of the profit after tax that we delivered last year. And even if you were to look at the consolidated performance, it turned out to be for a full year level also, we grew by about 68%. So very, very happy situation to be in, and largely because of the fact that our members are loving our experience. They are coming in. We are seeing huge momentum through referrals, digital, as well as the fact that we are able to get upgrades and new membership in our resorts through our on-site sales decks.
Yeah, 57%, if I'm not mistaken, through those digital channels, right? But I'm actually curious. I will come to the console picture and the Europe business, which turned around in the quarter. But I'm also curious about the contribution of F&B to that 80 crore number, as well as non-member sales, because I believe that is also one of the metrics to track. What led to that 80 crore number? Is that sustainable? And what is the trajectory going forward?
So if you look at our components of the resort revenue, the large component of our resort revenue, as you rightly said, is F&B. And because we do not charge the room rentals for our members, and that is a very, very significant component. There is another component, which is holiday activities. We offer our members spa services, various holiday activities in which they can keep themselves busy, enjoyable, and have a great holiday experience. So that comprises the balance part of it. The non-member is very insignificant because the non-member part is basically to get few non-members and prospects, we call them internally in our language, so that they can become members, because on-site sales is an important part of our membership. Our business is a membership business. Entire business economics, profits depend on our members coming to our resorts and actually are not dependent on non-members at all.
Right. Kavinder, speaking about the EBITDA margins in the quarter gone by, it stood at 25.2%, which is definitely above pre-pandemic levels. But if I look at it versus Q3, I see that it's fallen from over 29%. Why is that?
So if you're talking about the EBITDA margins this year and this quarter, we have been in full flow. So you would appreciate that when we get into the full range of activities, whether it is marketing activities, whether it is our resorts running, during the pre-pandemic or during the pandemic times, actually our margins went up because a lot of activities were not being done. But actually, if you were to compare from pre-pandemic times to now, our margins are up by at least 400 to 500 basis points at the PBT level and EBITDA level. So we have significantly improved our margins from the pre-pandemic levels. During the pandemic, our margins further improved because of the low levels of activity. Now we are in full flow of activities, and our margins actually, in a way, are impacted by only two things. When we drive member additions, you know that in our accounting standard, we have to account for almost all the cost of acquisition, but our income gets deferred. So to that extent, when we chase member additions, we do see a dip in the profits and margins. And also when we accelerate inventory, that also affects the margins, though not the EBITDA margins, but definitely below the EBITDA, which is the PBT margins.
Understood. That makes sense. So this is more to be around the range where we could expect the margins to be going forward as well, because we're at full operations, right?
Yeah. So I would say that, there are always opportunities for improving margins. If you look at our track record, we have been improving margins prior to pandemic. If you look at 4 or 5 years period, during pandemic, we further improved. Now we are slightly lower than the pandemic period, but still higher than the pre-pandemic period. We are confident of improving margins on a sustained basis moving into the future because of the various actions that we are taking. To just name one action, we have right now 22 resorts which are running on solar. We intend to double this during this year. All of this actually helps.
Okay. Again, question about the membership sales value, which, as I look at it on a year-on-year basis in the fourth quarter, has grown by a third. It's at 4 lakh. It's a little lower than the full year average of 4.2. But I'm actually curious about the granularity of this. What kind of sales are these? These are, and you would look at it in terms of longevity of those sales, right? How do you measure the way that this particular leg is moving?
So if you look at 2-3 structural changes that we did in the past. Earlier, we used to sell our membership with even lower down payment. Now, we insist on members paying a higher down payment so that we are in a position to attract the right member base, which will also spend money at the resorts. So that is one thing that we have done structurally over the last few years, which is playing out in terms of the numbers that you quoted. The second thing is that a lot of this, increase in the AUR that you are seeing, and even at a year level, is driven by the fact that we are trying to drive 3 things. Number one, drive a mix of products, which is healthy mix of longer tenure, medium tenure, and short tenure products. That is what also pushes the average unit realization. And the other thing also includes upgrades. We had the highest ever upgrades in the quarter and the year. That's also pushing up the average unit realization. And because, since you talked about what happens to these members, because they come with higher down payment, they also stay longer with us. And most importantly, they spend more money at the resorts, which is what you saw in the resort income. That is why the resort income of 80 crores is sustainable and beyond.
As I understand it, Kavinder, you're in the process of trying to diversify your user base. You have a large number of business owners that are part of the membership, and you're trying to tap corporates. What is the update there? And could you take us through the mix as of now?
So, historically, Club Mahindra has found favor amongst people who run small businesses, and they have enjoyed going in larger, groups, larger families and friends, and enjoyed the hospitality of Club Mahindra over the years. We have realized there is a huge interest amongst corporates because we also have, a product called Corporate Fund Days, where a corporate can buy a membership and give it to its employees. And we realized that while those employees are very happy, sometimes when they move to the next organization, they miss the fact that they cannot go to Club Mahindra. So our aim is to tap the corporate employees who would be very happy to enjoy our proposition of family holidays. And most importantly, since they are, normally in the employee circle, people are connected to each other, they could be great source for referrals as well. And I think their spending power also remains relatively undisturbed despite various challenges in the economy. And that also helps us to ensure that our resort spends will also remain robust, as if we change our mix in favor of corporates. We have put up a proper corporate sales vertical, which is focusing not just employees, but on the customers of corporates. So we are going into both employees and corporates.
Where does the split stand at right now, Kavinder?
So normally we do not give the split in the public, but the small business owners and professionals have higher proportion of our memberships than corporates employees as we speak.
Okay. I want to very quickly talk about the Europe business, which is turned around. Is that something that is now sustainable, that will now continue to contribute? And what are the key levers that you're watching for in that business?
So the Holiday Club Resorts business, which is Finland, Sweden, and Spain, indeed has turned around in Q4. Of course, it's a seasonal quarter, but remember that Finland has become a part of NATO. The consumer sentiment is upbeat, and the energy prices have cooled off from the higher levels. So we have seen a significant improvement in the business of selling timeshare as well as the spa hotels. In the Finnish economy, people are not able to buy homes because of higher inflation, but they can buy timeshare. They love to have a second home and a second place to go and enjoy a holiday with the family. It's their part of their lifestyle. So we are seeing a significant momentum in timeshare sales as well as in the spa hotels occupancies. Going forward, Q1 and Q3 are typically non-seasonal. Q2 and Q4 are seasonal quarters. But the fact that they have made significant structural changes in their cost structures will help them to actually deliver even better performance going ahead.
Now, final point here, I would like you to perhaps give us an inkling of what you're expecting in the new financial year. I think the theme of FY23 was indeed revenge travel at the start, and that kind of pushed the velocity through the year. But I guess we're past that now, and people are speaking less and less about COVID-19, Kavinder. So looking forward into the future, what do you think will drive your revenue and your growth? And do you have any concerns at all about a slowdown in Europe and that proving to be a bit of a drag?
So I think the difficult part, let me handle the Europe part earlier. The difficult part or the difficult time in Europe is over because, as I said, Finland has become a part of NATO. Inflation is coming off their peak. Energy levels are coming off. Consumer sentiment is improving. So I see only one way in Europe, which is one way which is up. And that is what I see in Finland, Sweden, and Spain. People are continuing to travel. Q4, Britishers, Germans, Dutch, they all came to the Finnish Lapland and they did their skiing. So there was no worry that there is a war going on and therefore people wouldn't travel. So in fact, people are traveling and they are spending money. As far as the situation in India is concerned, my belief is that we are in a very, very strong, tailwinds. You can see the airlines are running full. The fares are high, but yet the airlines are running full. People are traveling like never before. Whether it is revenge travel or whether it is a new trend to be, to sort of, go around and see new places, spend time with family. That's something that we are observing, that people would like to come to our resorts, spend time, quality time. They enjoy with the family during the day. They work in the evenings because of the connectivity. And also, government talking about tourism in mission mode, 50 tourist destinations, airports, infrastructure. There is a general positive mood that the travel is necessary and we must see our own country. And that is the benefit. That is what we are seeing in our business as well.
Last question, Kavinder, and that relates to your capacity addition. Last time when you spoke to BQ Prime, you spoke about 1,500 crores and a significant amount of rooms and resorts to be added. What is the update for this financial year and any acquisitions that could happen in this financial year?
So there is a definite possibility of acquisitions in this financial year because we have been working for a long time, because we want to accelerate. We are looking at now about 1,800 rooms or thereabouts, with about 1,700-1,800 crores kind of an investment over the next 3 to 4 years. We remain, and by the way, we don't need to borrow. to be in a position to do this because our business model allows us to deploy the cash that we already have. We have about 1,160 crores of cash on our books. So we are in a position to invest. We are in a position to grow. And just to let you know that as we speak, there are two very large projects, about 500 crores investment. Construction is already going on. One in Ganpati Phule, which started in April, and the other one which started in previous calendar year, in Kandaghat area, which is the Himachal area. Plus, we are expanding our own existing resorts, which is in Puducherry as well as in Goa. Plus, we are looking at a new resort in a place called Theo. And plus, we have land banks, which we will monetize during this year. So we remain pretty confident of putting in the money, acquiring and growing the resort inventory, and parallelly growing the member base to be able to fill up that inventory.
Well, it all seems to be going well. Thank you so much, Kavinder, for taking the time, and look forward to speaking to you next time. Thanks so much for speaking to BQ Prime.